Celsius. As if nothing worse could happen, a crypto platform with over 1 million users is on the brink of collapse. And this collapse could spiral the entire crypto market and your portfolio. So what in the world is even happening in this story? This market is exhausting. It's just one bad domino after another. Like most crashed companies, the Celsius offer seemed too good to be true. A platform that offered services far better than any traditional bank, huge returns up to 18% and zero fees. But now there's a platform-wide freeze and investors are panicking. So what caused this disastrous crash? Was it some kind of Ponzi scheme? Did it run into simple liquidity issues? Or is there some dark secret here for us to uncover? We're going to explore all of this because first I need to tell you about my new education platform, Finova, real quick. Investing feels pretty terrible right now, but now is also the best time possible to learn. On Finova, we have classes every single day, trade signals from experts, research reports not here on YouTube, and a community of thousands of investors chatting in real time. Here's what the members have to say about it. Now, with this new platform, we're limiting new users every month to ensure everyone gets the attention that they need before opening this up to everyone. So just, if you're interested, grab a spot ASAP. Okay, now back to Celsius. To explain, let's just imagine you're a regular Celsius user. You heard about them a while ago and you gave it a look over and you really liked what you saw. I mean, the banks that your parents use, they offer a tiny amount of interest. It's laughable. Celsius gives you a lot more, up to 100 times more. And they make a statement that basically anyone can get behind, that banks kind of suck. Now, Celsius isn't exactly a bank replacement. You kind of treat it like one, but it's more about getting that juicy passive income. It's not exactly a safe haven for your money. So you went ahead and you put some of your hard-earned cash into the Celsius network. For a while, things look good, great even. You even chuckle to yourself while driving past your local bank, thinking about the suckers who put their money in there. Life is good.
So long, suckers.
Then you wake up one day to find your worst nightmare has come true. Your money is frozen, every last penny. Have you been scammed?
You just run it again.
Could you come back when you have some money?
You immediately start reading mammoth-sized threads on Twitter and Reddit to find out what went wrong. Some voices are urging you to stay calm, pointing out that Celsius could never be 100% liquid because of its model. But digging deeper, you find longtime crypto heads saying, "I told you so," stories of surprisingly awkward withdrawal processes and concerning delays. This is often a sign of a company with liquidity issues, more cash going out than they physically have. You read posts saying to get out of the network just days before the collapse. They say something smells fishy. Withdrawals are getting even harder. They may be insolvent. They can't pay their debts. The CEO and his wife have been selling off tokens, but it's too late. However, there still is some hope. At least the Celsius team is working and answering questions, so it's not like they've completely just cut and run. But this is all so complex and technical. It's hard to give it the bullshit sniff test. Extreme market conditions, stabilized liquidity, over leverage, and what on earth is a ST-ETH? The strange thing about all this is you see two distinct groups of people. Those in total panic and those who are completely relaxed. It's hard to read, like which side of this should you be on? Those people who feel confident about getting a hold of their money have complete faith in the CEO, Alex Mashinsky, and the business model. They call the people who are being negative FUDs, blaming them and their fears for the crash, which I guess is kind of true. It's aggressive for sure, but technically, if no one took their money out, then this wouldn't have happened. But at the same time, you can't blame anyone for being extra careful right now. The FUDs get to say that they were right. They have their money right now. Then you get a bit sidetracked because you realize you don't actually know what a FUD is, so you Google it. Ah, that makes sense. Why do I do that? Sometimes I just put off learning the simplest thing for no reason. Oh shit, I'm getting sidetracked. The FUDs say it was a scam, the Ponzi scheme, or a flat-out bad business model destined to fail. And you're even more confused now. Why can't you get in plain English what happened to your money? Why is this so confusing? Okay. So you decide to go back to the beginning. What exactly does Celsius do? The CEO made this neat analogy about their business model being like borrowing a cup of sugar from a neighbor and returning back the cup plus a tablespoon more. Very quaint, wholesome almost. But those interest rates seem to be a lot larger than a spoonful. How many spoonfuls are in a cup anyways? And where does this extra spoonful payment come from? Who's paying for this? How could they be promising 100 times higher interest rates than bank in the first place? It's not like crypto magically multiplies money on its own. There had to be something else. And there is. It turns out there's really only two types of crypto lending platforms. Ones that offer market rates and ones that lose money. So starting with the market rates, this This is where you're actually lending out your money directly in a market to some other user who pays interest directly to you. So the rates are just simply supply and demand. Now, there are pros and cons to this. The downside of this is that rates can change dramatically. I've done a lot of lending stable coins and other tokens on KuCoin, and I've seen rates as high as 50% APY when there's huge demand, but also as low as 1% when the market is crashing. So the rates aren't as consistent. However, you don't have to worry about the institution trying to afford to pay you. Here's how much I made with KuCoin lending in the last year. I'll have them linked in the description if you want to try it out for yourself. Then we have platforms that lose money. Most crypto lending platforms simply can't afford to pay 8% plus in interest forever. But they know that that draws in new users, so they use this as a loss leader. They lose money on that so they can make money elsewhere from you as a customer, and that's totally fine. Most of these platforms have huge amounts of cash to draw from, but the rates, of course, can't last forever. Celsius falls into that camp. Yes, they're making money lending out currencies, but it just wasn't covering their entire 18% nut. The operating model for Celsius seems pretty similar to a bank. People make deposits and earn interest. Other people borrow money and pay interest. So in your search, you go back to that phrase, bank run. I mean, this sure looks like a bank run. They just ran out of money, liquidity, sugar, or whatever. And then you see someone saying that it looks like a Ponzi scheme. And it does have traits of a Ponzi as well. I mean, it promised outsized returns. It appears to be insolvent, however, that hasn't been confirmed. But insolvent or not, it's clear that the system could only handle so much pressure before it burst. And here's the pressure you ordered. The model relies on fresh money coming in at all times to pay old investors or it collapses, and that kind of sounds like a Ponzi scheme, right? If the fear spreads too widely, the new money dries up, then current investors get nervous and withdraw, and then you end up with not enough money in the pot to pay the people who are still there. The problem is, something can have Ponzi-like traits and not technically be a Ponzi. Look at gold or the US dollar. Both check a few boxes, so it's hard to determine. You can't say something's bad because it has a couple Ponzi-like traits. So you put the idea of it being a Ponzi to the side for a while because something even shinier caught your eye in this research. Conspiracy theories. You've been trying to avoid them in this research, but now it's time to delve deeper. I mean, who's to blame this time? The Illuminati, shape-shifting lizards, Nancy Pelosi? Some claim that this is an attack orchestrated by big names and influencers. Others say it's third parties who sold their staked ether to deliberately try to hurt this network. This is important to note because Celsius has a ton of this ST ETH. See, the problem is that a huge part of their treasury is locked up until Ethereum completes the transition to the new proof-of-stake model, which could take several months. This means that they have even less money to pay out people trying to make withdrawals, and it's even worse than that because staked ETH should always be the same price as one regular ETH since it essentially represents the same asset. Well, when people began selling off their staked ether, it fell off that peg. And this, of course, caused even more panic and more selling, which made that price go down even further. So not only does Celsius need the value that's locked away right now, the asset that they're holding, staked ether, is becoming extremely stressed. It's not a great outcome for a network whose biggest risk is running out of money. So how are other cryptocurrencies affected by this? Well, we saw it immediately. Crypto prices melted away across the board. Again, this of course just piles on existing fears thanks to the Luna collapse, inflation, the stock market regulations, home prices, and just about everything else that matters in the economy. Right now, the market is just kind of sitting, waiting to see if there will be some kind of total implosion of Celsius. What happens next? Well, regulators are also looking closely at this disaster. CEO Alex Mashinsky has fought to keep Celsius away from the strict controls that banks have to deal with. And this sounds great and all, but one of the unfortunate side effects of this is that their customers are unsecured creditors who aren't protected by insurance in the same way normal bank customers are. It's all right there in their terms and conditions. With the benefit of hindsight, Celsius is basically a higher risk interest-bearing account. Anything that offers way above market rates is just going to be more risky, which is fine if you understand what you're getting yourself into. However, that's not exactly helped by the fact that high-risk crypto ventures often try to make their business model sound a whole lot simpler than it really is. It's not all sunshine and rainbows. That sugar example from earlier deliberately makes it sound like some good old risk-free borrowing to rosy-cheeked neighbors. People would be less likely to sign up if they understood the complexity of things like staked ether. Yet here we are. Celsius over-leveraged and ran out of liquidity. What they need to do now is convince investors to give them more cash to solve this problem, that the business model can be fixed. And it looks like it's beginning. They're paying off as many debts as possible, and they could restructure the business, but it might not work. An anonymous source revealed that some of their largest investors might not be there for them or might wait for the restructuring to happen first. And this is far from ideal for Celsius users who are essentially left to sit there and wait, hoping for good news, hoping that this crisis will be averted. And I just hope for the sake of everyone invested that this is just a bump in the road for Celsius, that the market trends upwards and these weaknesses can be fixed. Now from here, I highly recommend checking out this video on a fund currently investing $4.5 billion into the crypto market. It's a fascinating story.